Sir, excuse me, sir. ଗୋଟେ device ର volume sir ଟିକେ କମ କରିଦିଅନ୍ତୁ ଦିଟା device ଅଛି। echo ହଉଛି।
What?
Sir, ଦିଟା device ର ଗୋଟେ volume କମ କରିଦିଅନ୍ତୁ sir। phone ର କିମ୍ବା PC ର ଗୋଟେ volume କମ କରିଦିଅନ୍ତୁ। echo ହଉଛି sir।
Now is it audible?
Yes, sir. Audible.
Yes, sir.
Is it audible now?
Yes, sir.
Yes, sir. We are able.
Hello.
Sir, we are not audible.
Hello. Is it audible now?
Yes, sir.
The volume of the system. Is it audible now?
Yes, sir.
Audible.
Audible. Yes, sir. Audible.
But we are not, sir.
हाँ कौन दो सूझ तो Okay. So today we'll discuss about the electronic banking system. As I said to you, basically in the post-liberalization era, it is the banks which have made themselves more technology driven, because with the allowance of more and more private banks into the banking system as well as foreign banks into the banking system, the competition among the banks existing in the country become more cutthroat. So to survive in this competitive environment, they need to provide better service quality, convenient service quality, easier service quality to the customers. And because they felt the fact that time is precious for the customers, therefore they try to save on time also. That is the reason why the electronic banking system came to play. The electronic banking system basically is the system whereby the banks go on to provide the banking services through an electronic mode, and more particularly with the help of internet facilities. And the electronic banking system is always considered to be a 24 into 7 into 365 days banking. 24 into 7 into 365 days banking means the customers at any point of time and at any place can automatically get the access to their financial accounts being held with the banking institutions. So for the electronic banking system to work, it is highly required that the customers need to be internet savvy, and the bank also should provide such type of services with the help of internet, which can ultimately benefit the customers as well as the bankers. Now, unless and until internet facility is there, the electronic banking system cannot work. So it is nothing but the provision of banking services through electronic media, which is particularly with the help of internet facilities. Now, coming to certain key aspects of electronic banking system. What are the basic areas which entails the success of this electronic banking system? Because as I have already pointed out, since the last 25 years, this system actually has replaced the traditional banking system. Earlier, what is happening? The customer have to reach to the bank branches, wait for there over a long period of time. So those things were needed to be sorted out because of the passage of time in the hands of the customer, or you can say that because the customers have many works to do, so they cannot spend a lot of time in the bank branches. And if bank branches are full of customers, then automatically it will affect the operational efficiency as well as the productivity of the employees. That is the reason why the electronic banking system has been introduced. And looking at the key aspects, we can say that the first major key aspect is your convenience and accessibility. Convenience and accessibility. That means the electronic banking system is accessible to all who are having an internet facility with, maybe through mobiles or through any desktop or laptop. If you have any internet facility, then you can easily access to the banking transactions or to your financial transaction with the bank. So accessibility indicates that at any point of time, the customer can access to the bank accounts which they are maintaining with their bank branch. Convenience means as per their convenience, they can do it. Wherever they are in, it is not mandatory that they need to move to the bank branches. By sitting at home, by sitting at offices, by moving in the aeroplane or in the train, they can do the banking transactions as per their convenience. So the system of electronic banking actually helped a lot the customers in providing convenience to them, as a result of which, as per their convenience, they can do the banking transactions, and it is also accessible because we are saying that it is a 24 into 7 into 365 days banking. The second key aspect is range of services. It is not possible on the part of the banks to provide all such services to their customers at the branch level itself. So at the branch level, what was actually being done, either acceptance of deposits or uh, giving up of, you can say that your demand drafts or pay order, or in case any loan has to be disbursed, then the loanee must have to meet with the banking officials. So only those things were being carried out particularly.
Sorry, sir. Second
Therefore, the range of services was
point
confined to certain areas during the traditional banking system. But because of the electronic banking system, there are an array
Range
of
of
services
services.
which are supposed to be provided by the banks. You can make payment to the third parties by using your bank account through the electronic banking system. All of you might have gone through this by using your debit card. You can make payment to the third parties. Uh, Also, by using your debit card, you can book your train tickets. So, a lot of add-on facilities along with the core facilities the banks were being able to provide because of the introduction of the electronic banking system. Therefore, we can say that the number of services which are being offered by the banks because of the introduction of the electronic banking system has tremendously increased. The third is your enhanced security measures. Now, as the transactions in the electronic banking system are supposed to be carried out electronically, there is always a possibility that because of some error, there is a chance that money might be lost. So for that reason, or if suppose your debit card is being lost, or if suppose your PIN number is being stolen by somebody else, or because of some unfortunate events, the PIN number is being accessible to somebody else,
Which is the third
and by
one?
using that, that person can go on to
Enlarged,
take money
enhanced.
from your account. So for that reason, certain security measures have
Enhanced
also been
security
provided
measures.
because in the electronic banking system,
Thank you.
security is considered to be the important aspect. And unless and until security is being provided, there is every chance that the customer might not use it. As you know, every positive thing is being attached with certain negative aspects also. So this electronic banking system is associated with the security problem. So to counter that, there has been enhanced security measures being provided by the banks. You can say that from time to time you can go on to make your PIN number. They are supposed to give or provide you with the biometric facility unless and until you put your finger on the phone or on the laptop or desktop, it cannot open. So biometric system has come out, the PIN number has come out, uh, and at the same time, many such facilities in the modern day era has also been introduced in order to enhance the security measures in case of electronic banking. Then comes the cost savings. Now, as I have already pointed out that because of the electronic banking system, the customers can conveniently do their banking transaction with the bank. So they need not have to visit to the bank. As a result of which they can save on their transportation costs. Similarly, the bankers also can save on their operational cost. And with low cost, you can carry out the banking business with the help of the electronic banking system. If you are doing all the banking transactions by sitting at your home, you are not supposed to pay a large amount in the form of fee. So for that, for maintaining your account, whatever is supposed to be debited from your account at the end of a certain period, maybe 6 months or maybe 1 year, that will definitely be debited. but you can save on certain costs, particularly from the customer point of view. They can save on their time, they can save on the transportation cost, and with less cost, they can have an access to the banking transactions. Uh, and accordingly, the banker also is being uh, provided with the opportunity to reduce the operational cost, because the bank branch will not always be filled with customers. Because of the electronic banking system, there has been a less footfall of customers in the bank branches. As a result of which, they can focus on their job, and accordingly, their productivity level will also grow. So, cost savings is also another key aspect of the electronic banking system, both from the banker's point of view as well as from the customer point of view. Then comes the technological advancements. Because of it is somewhere also related to the enhanced security measures. Because of the technological advancement, new technologies are adopted, and the banks are supposed to use new technologies for it. And because of that, the electronic banking system helps in the technological advancements, or in this era of advanced technology, we can also do the banking transactions by sitting at our home, or more conveniently with more technology oriented banking business. So technological advancements actually result in the increment of the electronic banking system across the globe, because of which the customers are now much more eager to have this electronic banking system facility. Then comes the financial inclusion. You know what financial inclusion is all about? Financial inclusion means including all the people under one group, or including all the people with the banking business. Financial inclusion is a broader term. That means you need to include all strata of the population of a country to be financially stable, to be financially viable. Under financial inclusion, what happens? The no frill accounts are being opened. By no frill account, I mean the zero balance accounts, whereby everybody is supposed to open the account with the bank without any hassles. It should be hassle free. So electronic banking system actually helps in more financial inclusion, because as you have already found out, in our case in India, because of the direct benefit transfer system, whereby the government is supposed to make the benefit in the form of payment to the beneficiaries, it is required that all the beneficiaries must have their bank account. It might be in the form of a subsidy, whereby gas subsidy is being provided, agriculture subsidy is being provided, and along with that, some pensions are also being provided. Might be in the form of widow pension, might be in the form of old age pension, whereby almost all the strata of the population, including the people living in the village areas as well as in the remote areas, they are supposed to get the benefit from the government. Now, for that, for ensuring that the benefit is actually reaching them, the government is making it mandatory that everybody should have their bank account. And it is not possible on the part of all the account holders to come to the bank branches. So if they open the bank account, automatically whenever the benefits are supposed to be transferred from the government, it will transfer to their account, and by sitting at their home, they can easily track whether the money has come or not. So financial inclusion means including more and more people under the banking umbrella. It is from the banking point of view, financial inclusion from the banking point of view, or from the point of view of banks means including all under the banking roof. So electronic banking helps in the financial inclusion because of this. I have already given you the example of direct benefit transfer. Because of that, all the people are required to open their account with the bank, and the result of which the number of customers of the banks are increasing day by day. Then next one is your regulatory compliances. The electronic banking also needs to comply with certain regulations, certain uh, uh, rules, because as there are certain security challenges, so they need to operate under certain guidelines, under certain rules, under certain regulations. And because of the electronic banking system, it is easier on the part of the regulator to find out what the bank is doing. That is the reason why the activities of the banks can clearly be monitored, and the regulator can assess whether the banks are compliant with the rules and regulations or not. So, electronic banking system actually helps the banks to comply with the regulations. The next one is your changing customer expectations. Changing customer expectations. Changing customer expectation means the customer expectation has changed a lot because of the electronic banking system. The customer wants the banking services to be provided to him or to her at its doorstep. Because of the expectation of the consumer, the banks are forced to adopt the electronic banking system. By sitting at your home, you can do fund transfer from one account to another. By sitting at your home, you can make deposit to your account. By sitting at your home, you can make payment to the third parties by using your bank account. So many such services are being provided, and because of that, the expectation of the consumer since has changed. The electronic banking system helps the banks in meeting these changed expectations of the customers. So these are the basic aspects, or you can say key aspects of electronic banking system, which generally is considered to be the need of the hour for all the banking institutions. Are you all clear?
Yes, sir.
Then coming to the functions of RBI. As we have already pointed out in the last class, that every country in its banking system has an apex banking institution. And the role of the apex banking institution is being discharged by the central bank of the country. In Indian case, the central bank is in the form of RBI. RBI is there to supervise, to control, as well as to monitor all the activities of the banking institutions operating in the country. So there is a huge role to be played by RBI because the banks are dealing with public money. So it is the responsibility of the RBI to ensure that wherever the money is supposed to be used by the banking institutions, it should be used in a fashion whereby they can ensure the safety of those funds, the security of those funds. And also RBI has come out with certain guidelines regarding the investments to be made by the banking institutions. And the most important aspect related to the functioning of RBI is that the RBI is actually acting as banker to the government. So for the central government, the banker is none other than the RBI. So on behalf of central government, the RBI actually carries out all the banking transactions for the government. Therefore, the role of the RBI is considered to be most vital for ensuring the smooth functioning of the banking institutions in a country, as well as to ensure that there is a robust financial system, particularly in the banking sector, which is operating in the country. Therefore, we need to find out what basic functions the RBI generally performs. Now, coming to the functions of RBI, you can find that the major function is that it has the monopoly of note issue. Monopoly of note issue. By note, we mean the bank notes. Whatever transactions we, the public in general, are doing, the transactions get settled with the help of the bank notes. It is nothing but the currencies. Here, by note, we mean the bank notes. By bank note, we mean the paper currencies of all denominations except rupees 1. Except rupees 1 paper currency, the other denominated paper currencies are considered to be bank notes. It includes 5 rupee note, 10 rupee note, 20 rupee note, 50 rupee note, 100 rupee note, 200 rupee note, 500 rupee note, 2000 rupees. Nowadays, 2000 rupees is being uh, taken out from the market because of the government regulations. So all those notes are considered to be bank notes, and it is the RBI which has the monopoly to issue these notes. Therefore, on all these notes you can find the signature of the RBI governor. But apart from these notes, the 1 rupee currency, paper currency note, as well as the uh, coins, or the, you can say that the currencies which are in the form of coins, they basically are being uh, issued by the finance ministry of the country. So RBI doesn't issue the coins. That means the 1 rupee coin, the 2 rupee coin, the 5 rupee coin, the 10 rupee coin. Nowadays it is also the 20 rupees coin, even 75 rupees coin have also come out. So all these coins are being issued by the finance ministry of the country. But apart from that, and also 1 rupee currency note, 1 rupee currency note is also being issued by the finance ministry. Nowadays, you cannot get any 1 rupee currency note because it is not in circulation nowadays. So starting from 5 rupees note, then 10 rupees note, 20 rupees note, 50 rupees note, 100 rupees note, 200 rupees note, and 500 rupees note. All these notes are being issued by the RBI. No other agency, no other authority, no other organization can issue such notes. And since these are issued by RBI, these are considered to be the legal currency notes. And these are basically being used in the transactions which the public in generally undertakes. So for settlement of transaction, whatever notes are supposed to be used, they are supposed to be issued by the RBI. Second one is your banking supervision and control. As I have already pointed out to you, being the apex banking institution, it is the responsibility of RBI, particularly in India, that it must properly supervise the activities of all the banking institutions. Whatever activities is being carried out by the banking institutions, those activities are supposed to be supervised properly by the RBI. And RBI also has control over the functioning of the commercial banks. In whatever way the commercial banks functions, all the functions are being controlled by the RBI. So they need to function as per the guidelines, as per the prescriptions, as per the orders of the RBI. They cannot function on their own or arbitrarily. So banking supervision and control is also one of the major functions of RBI. Then third one is your monetary policy formulation. Monetary policy, the other name of this monetary policy is your credit policy. And basically the purpose of this credit policy is to ensure the stability of the currency. That means to ensure that currency is stable. There should not be a huge increment or huge fall in the value of the currency. Whenever it happens, the RBI needs to intervene and accordingly try to control the situation. And at the same time, through credit policy, the RBI wants to achieve another goal, which is your higher economic growth. So monetary policy or credit policy is being drafted as well as is being provided by the RBI twice in a year. First, it's an annual credit policy which is supposed to be released in the month of April, and there is a midterm credit policy, midterm monetary policy, which is supposed to be released in the month of October. And in this credit policy, the RBI has come out with certain measures in order to control the fluctuations in the value of our local currency, which is nothing but the rupees. And through this credit policy, the RBI also can prescribe all the banking institutions how to deal with the customers, because there are different types of customers and whom to give what amount of credit, what should be the credit limit, what should be the credit process. All these things are being prescribed in the credit policy. So credit policy, in a nutshell, you can say that plays an important role in ensuring the overall economic growth of a country. Because of that, there is the importance of monetary policy or credit policy. And this monetary policy is being formulated by none other than RBI. So this is also one of the functions.
Hello.
I have explained to you. Please speak up. Any one of you, please
Hello.
speak up. Whether you are being
Hello,
able to
sir.
understand whatever I have explained to you or not.
Yes, sir, we are
Hello.
understanding.
Hello. 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 Hello.
Please, any one of you, please speak. Sir, you are unable to hear us.
Hello. Anyone can unmute?
Hello.
Yeah.
Sir, hello.
Any one of you can unmute.
ସାରଙ୍କର ଭଲ୍ୟୁମ୍ କମ୍ ଅଛି ସେଥିପାଇଁ ଶୁଭାଯାଉନି।
ଠିକ ଅଛି ଏବେ ଶୁଭୁଛି।
ସାରଙ୍କୁ କିଏ କୁହ ଦୀପକ ସାରଙ୍କୁ ଫୋନ କରିକି।
ଏବେ ଶୁଭୁଛି ଆପଣ ମାନଙ୍କ କଥା।
ଆରେ ଆମର କାହା ପାଖରେ ଦୀପକ ସାରଙ୍କ ନମ୍ବର ଅଛି? ଏନିୱାନ୍ କ୍ୟାନ୍ କଲ୍ ହିମ୍।
ସାର୍ କହୁଛନ୍ତି ପା କଲ୍ କଲେ ତ ଦୀପକ ସାର୍ ଫୋନ ଉଠଉନାହାନ୍ତି। ଆରେ ଦୀପକ ସାର୍ ହିଁ କହୁଛନ୍ତି ଅଛନ୍ତି।
ତ ସିଏ ତ ତାଙ୍କ ଭଏସ ଆମକୁ ତାଙ୍କର ଶୁଭୁଛି, ଆମର ଶୁଭୁନି ତାଙ୍କୁ ହେଲା।
ସାରଙ୍କୁ କୁହନ୍ତୁ ସେଇଠି ମେସିନ ଭଲ୍ୟୁମ୍
Charge
ବଢେଇବେ। ସେଠି
system,
ଯୋଉ
ହଁ
ସିଷ୍ଟମ ଅଛି
ଶୁଣିଲେ ସିନା କହିବା।
ଭଲ୍ୟୁମ୍ ବଢେଇବେ।
ଆରେ ସେ ଶୁଣିଲେ ସିନା କହିବା।
ସେ ମେସିନ କୁ ଟିକେ ଚାହା ପିଆଇ ଦିଅନ୍ତୁ, ତା ଭଲ୍ୟୁମ ବଢିଯିବ।
ଚାଟ୍
ନାଇଁ
ବକ୍ସ ରେ ଲେଖ, ଯାହାର ଲେଖିବା ଅଛି ଚାଟ୍ ବକ୍ସ ସାର୍ ପଢିବେ।
ଆପଣଙ୍କ କଥା ସାରଙ୍କୁ ଶୁଭା ଯାଉଛି।
ଶୁଭାଯାଉଛି? ହଉ ଠିକ ଅଛି।
Hello. ନା ସେ ଶୁଣି ପାରୁନାହାନ୍ତି।
Yes, I am hearing.
ଶୁଭୁନି ସାରଙ୍କୁ ଶୁଭୁନି, ସେଥିପାଇଁ ସେ
ଶୁଣା ଯାଉଛି।
ଆଚ୍ଛା ସାର୍ ଶୁଭୁଛି। ଗୁଡ୍ ମର୍ଣ୍ଣିଂ।
ଶୁଭୁଛି। ବର୍ତ୍ତମାନ ତମେ ମ୍ୟୁଟ କର, ଶୁଣ।
ଠିକ ଅଛି ସାର୍।
The next function is your foreign exchange management. As you know, in this era of globalization, foreign exchange will basically decide.
ଆପଣଙ୍କ ଭଏସ ଟି ଶୁଭାଯାଉନି।
ଭଏସ ଶୁଭାଯାଉନି?
ସାର୍ ଶୁଭିଲା, ଏବେ ଶୁଭିଲା।
ଏବେ ଶୁଭିଲା ସାର୍।
ସାର୍ ଏବେ ଶୁଭିଲା।
ଆଗ ଯାହା ପଢେଇଲି କିଛି ଶୁଭୁନି?
ସେଗୁରା ସବୁ
ନା
ଶୁଭିଥିଲା।
ସାର୍ ଶୁଭୁଥିଲା, ଆମେ ଯାହା କହୁଥିଲୁ ଶୁଣି ପାରୁନଥିଲେ ଆପଣ।
ହଁ ନାଇଁ ସେଇଟା ଦୀପକ ସାର୍ ଆସି କଲେ ଯେ ସେଇ କଥା ମୁଁ ପଚାରୁଥିଲି ତମେ ଜାଣିପାରିଲ ନା ନାଇଁ?
ନାଇଁ ସାର୍, ଯାହା ବୁଝେଇଲେ ଆମେ କ୍ଲିୟରଲି ବୁଝିପାରିଲୁ। ଦେयर ଇଜ नो ଇଶ୍ୟୁ।
Needed and the responsibility of managing the foreign exchanges of a country rests with the central bank of that country. And because RBI is acting as the central bank, and because RBI is acting as the bankers to the government, therefore RBI also is in charge of managing the foreign exchanges, whereby by managing foreign exchanges, it can ensure the improvement in trade relationships with the rest of the world, which ultimately will lead to the higher growth of the country. So foreign exchange management is also considered to be another function. Then comes under the functions of RBI, we have a major function which is your credit control. It is a part of this monetary policy. By credit control, we mean controlling the credit facilities. Nowadays, you can find out that there has been a huge increment in the provision of credit facilities, particularly to the retail customers. By retail customers, we mean the individual customers. If you want to purchase any consumer durable, if you want to have your own house, if you want to have your own vehicle, then for all these purposes, the credit facility is being provided by the banking institutions. So credit control is highly necessary for ensuring there is a control over the fluctuations in the price level, which is related to the monetary policy. Now, this credit control is supposed to be the major function of RBI. How RBI controls the credit? It controls the credit through some measures. That means the tools of credit control, if you try to find out, then the tools are basically in the form of CRR, that is cash reserve ratio, then SLR, that is statutory liquidity ratio, then margin requirements, then your repurchase option rates. So by making changes in the repo rates, the credit can also be controlled. Then consumer credit regulations.
The consumer
Credit regulations. Consumer credit regulations.
sir, or certified second one is
SLR, CRR, SLR, then margin requirements, then repo rates, then consumer credit regulations. CRR means the cash reserve ratio. It basically refers to the portion of the total deposits mobilized by the banks which they are mandated to keep with RBI in cash form. That is CRR. So if 100 rupees suppose is being mobilized in the form of deposits by the banks, they are supposed to keep a certain portion, might be 5% to 6% with RBI in the form of cash. So out of 100 rupees mobilized in the form of deposits, let's suppose 5 rupees is being kept with RBI. SLR means statutory liquidity ratio. It is that portion of the total deposits of the banks which they are mandated to keep with themselves in order to meet the requirements of their depositors. Because the banks are dealing with public money, they do not know at what point of time the depositors will come and ask for repayable of their money or ask for withdrawal of their money. So they need to be ready enough, as we have already pointed out in the principle of liquidity while discussing in the last class, that the bank should always be ready enough to provide the money required by their depositors. But the bank is unaware about the fact at what point of time, what number of depositors will come and what amount they will ask for. That is the reason why they need to be prepared always. So for that, they need to maintain this SLR. And the SLR basically varies from bank to bank, but there is a limit to the SLR being imposed by the RBI, minimum limit. And nowadays the minimum limit is, I think, is supposed to be 17-18%. So out of 100 rupees, 5 rupees in the form of CRR they need to keep with RBI. 18 rupees minimum 18 rupees. That means a bank can keep more than 18 rupees, but it cannot keep less than 18 rupees. 18 rupees is the, or 18% is the minimum limit. So 5 rupees in form of CRR, 18 rupees minimum in the form of SLR. That means 23 rupees has gone down. So the bank will have 77 rupees with it to provide in the form of loans and advances as well as for investment purposes. Margin requirement means at the time of providing loans, the banks need to keep certain portion of the loan in the form of margin. Margin is basically being insisted upon to take care of the depreciation of the assets which are being kept in the form of security for taking the loan, and also margin is required for the purpose of enhancing the ability of the borrower or ability of the loanee to make the repayment in proper time. That means suppose you are being sanctioned with a 1 lakh rupees loan. So on that 1 lakh rupees of loan, you are supposed to keep a certain portion in the form of margin, whereby the margin will be kept in the form of a fixed deposit for the time period for which the loan has been sanctioned. Suppose a loan has been sanctioned for a period of 2 years and the loan amount is 1 lakh rupees. The bank, before disbursing the loan amount to the loanee, will ask the loanee to keep a minimum of 10% to 30%. Minimum of 10%, maximum is 30% of the loan amount to keep in the form of margin. That means suppose if you take 10%, then out of 1 lakh rupees, first as a loanee you need to keep 10,000 rupees in the form of margin, then you will get the 1 lakh rupees. Or else if you do not have 10,000 rupees with you, then 10,000 will be deducted from that 1 lakh rupees. It will be kept in the form of deposits. Rest 90,000 will be given to you but you will be asked to pay interest on 1 lakh rupees and you will repay 1 lakh rupees with interest within the 2-year time. That is known as margin requirement. Repo rate, it is a rate at which the central banks normally provide short-term advances to the commercial banks, and by making changes in the repo rate, they can ensure that the deposit rate as well as the loan rate also changes. And by making changes in the deposit and loan rate, they can go on to control the credit facility. Then consumer credit regulation, it means there has to be specification. There are different types of consumers which the RBI has segregated the consumers into. And to what type of consumers, what is the maximum limit of loan that can be given by the banks, that is being prescribed by the RBI. And accordingly, the banks will have to follow that.
Excuse me, sir.
Yeah.
Point number 4 and 5.
Repo rate means the rate at which the RBI provides short-term advances to the commercial banks. That means advances are in the form of a loan. So, for the short period of time, whatever loans are being provided by RBI to the commercial banks, the RBI takes interest on that. That is the rate. That rate is known as your repo rate. Any fluctuations in the repo rate can affect the deposit rate, that is rate on deposits, as well as the rate on loans. By making changes in the repo rate, the credit overall can be controlled by the RBI. Last one is your consumer credit regulation. The RBI has segregated all the consumers into different sections, into different types, and by giving prescription to the commercial banks which type of consumers should get maximum what amount of loan, it tries to control the credit. Many times what happens, there are certain groups who have the habit of taking loans but not repaying them. So through this prescription, the RBI might ask the commercial banks not to provide loan to those sections of the consumers. That is known as a consumer credit regulation. Understood?
Yes, sir.
Yes, sir.
Then another was in your research and data collection. The RBI's main function is to research as well as collect data pertaining to the availability of finance in the country, as well as pertaining to how finance can be arranged. Because there is a separate wing in the RBI which are into this research and data collection, and accordingly, this function helps a lot in discharging the third function, which we have written as monetary policy formulation. So, for the formulation of monetary policy, the RBI requires a number of data from all the sectors. It requires data, how the sectors are performing, what type of financial requirement is there in each and every sector, how the financial requirements can be met. So all these data are needed to be collected by RBI, and the RBI also enters into research to find out what is the financial position of the country, how the financial position of the country can be improved, what steps should be taken so that money can be circulated at large, so that the banking facilities can be provided to every nook and corner of the country. That is the reason why this also constitutes another function of RBI. So this is all about your another one is your financial stability. As you know, every country needs to be financially stable, because without financial stability, the country is supposed to face with serious problems. So every country tries to ensure that more or less financially they are stable. So how the financial stability of the country can be ensured, that is the responsibility of the central bank of the country. And in our case, in case of India, it is the RBI which must have to function in such a fashion whereby it can ensure the financial stability of the country. In case RBI finds that there is supposed to be some sort of instability, then proper actions, proper measures should be undertaken at the earliest to ensure the stability regarding the financial position of the country, so that the country can get over that particular type of situation. So this is all about the functions of RBI. Clear? Now we have gone through the bank, the banking system, the principles of bank, the electronic banking system, and the functions of RBI. Another two parts are there, which basically focuses on the uh, Banking Regulation Act. Now, whatever activities the banks are undertaking, whatever functions the banks are discharging, or whatever might be the reason for the existence of banking system in a country, the fact remains is that the banking institutions as a whole, they basically deal with public money. They mobilize the money in the form of deposits, and with that money, they go on to provide loans and advances to those who are in requirement of it. So because they are considered to deal with public money, because they are supposed to be public companies by nature, public company doesn't mean public sector company. We have already pointed out public sector, private sector, foreign bank and others. All of them are public companies. That means where the public is a stakeholder, because all of them are dealing with public money. So because they are public companies, so it is the responsibility of the government that it need to ensure that all the institutions are well regulated. And in India, you can say that there are certain legislations which generally entails how the banks in India should function. One such legislation is your RBI Act 1934, and another such legislation is your Banking Regulation Act 1949. The provisions of these two regulations are applicable to the functioning of each and every bank operating in the country, whether it is a foreign bank or it is a public sector bank.
So what is the
or
topic,
it is a
sir?
private. What?
Topic?
Banking? What are you saying?
I'm asking what is the topic? RBI Act
The, pur-
1937.
the purpose of these two acts is to regulate the activities of the commercial banks or activities of all the banking institutions. In whatever way the banking institutions function, they need to function as per the provisions of this act. And as you know, act is in the form of a legislation which is ultimately being passed by the parliament of the country. So whatever provisions are there in the Banking Regulation Act as well as in the RBI Act, as per those provisions, the banks need to function. So they cannot function arbitrarily. They need to function as per the provisions which are there in these two major acts. Out of which this BR Act is the important one. related to the capital requirement, related to the setting of branches, related to the settlement of uh, any dispute between the customer and the banker. So related to all these areas, provisions are being made in the Banking Regulation Act. So we'll go on to find out what areas are there on which the provisions are being spelled out in the Banking Regulation Act and how those provisions are being carried out by the banks. Clear? Next class we'll do that. Tomorrow we'll do that, and also we'll go through some aspect of insurance and we'll complete this module. The next